Okay, stop what you're doing. Seriously. If you own Broadcom, or honestly, if you're even just thinking about buying into this massive AI infrastructure boom, you need to see this 5-model valuation breakdown. Last week, I sat down and ran Broadcom through 5 distinct valuation models, plus the legendary investment checklists of Warren Buffett and Peter Lynch, and, well, what I found absolutely shocked me. Here is a massive truth that nobody is really talking about right now. This stock's intrinsic value could technically be framed as 6.9% undervalued by some popular models. But, and it's a big but, it's currently trading at a staggering 84.7 times its price-to-earnings ratio, right? That is a literal massive premium. So it begs this really bold question. Does a $100 billion AI pipeline actually justify paying 84 times earnings? Or are we staring down the barrel of a hidden ecosystem war that could tear this company's moat to shreds? Look, I know exactly what keeps retail investors up at night. It's that terrifying fear of buying at the absolute peak of a hype cycle only to watch your portfolio bleed out when the market narrative suddenly shifts. We've all been there. But listen, by the end of this explainer, you are going to know exactly if Broadcom is a Buffett buy or a Lynch trap. And I promise I'll give you a super clear, actionable framework that you can just steal for your own fundamental analysis. The market right now is treating Broadcom like an unstoppable bullet train. But what actually happens when NVIDIA and Marvell lay down tracks to derail it? Let's dive in. All right, so here is our roadmap for today. We're going to kick things off with the AI infrastructure boom and then look at why custom chips are winning over GPUs. After that, we'll decode the fair value, check out the VMware cash flow, analyze this huge threat from NVIDIA and Marvell, and finally figure out, is the premium actually justified? So let's jump right into section 1, the AI infrastructure boom, and try to really understand Broadcom's record quarter. I mean, just look at the sheer velocity of this number. 143%. That represents Broadcom's massive year-over-year growth in AI semiconductor revenue, hitting a record $10.8 billion. To put that into perspective, almost half of every single dollar Broadcom earned this quarter came directly from AI chips. The growth engine here is literally firing on all cylinders. But here is where we hit a really fascinating paradox. Ask yourselves this crucial question. If the growth engine is firing this hot and management actually raised their future guidance, why in the world did the market react with a 3% drop after hours? It kind of feels completely backwards, right? Moving on to section 2, custom chips over GPUs. This right here is the secret to Broadcom's moat. Think of this as the custom tailor versus off-the-rack analogy. On one hand, you have off-the-shelf GPUs, like NVIDIA's. Now, these are highly flexible, general-purpose chips that are absolutely great for training models. But on the other side, you have Broadcom's custom ASICs and XPUs. Hyperscalers, the massive tech giants, they desperately need Broadcom's custom chips to avoid the astronomical unit costs and massive power demands of standard GPUs. They need silicon that is perfectly optimized and tailored specifically for their own massive-scale workloads. And just look at these heavy-hitting partnerships. This shows exactly how Broadcom locks in clients for years, creating incredibly high switching costs. Google extended their TPU partnership all the way to 2031. Meta's deploying 3 gigawatts of power through 2028. OpenAI has silicon on track for late 2026. Because these custom chips are co-designed from the ground up, customers can't just easily pack up and switch to a competitor. That whole dynamic creates a highly sticky $30 billion AI booking backlog. All right, section 3, decoding the fair value. Let's see if the price is actually right. We are looking at a pretty stark reality here. Despite a fair value narrative floating around out there that points to about $480, Broadcom trades at a massive premium with an 84.7x PE ratio. Compare that to the US semiconductor industry average of 66.9x and the calculated fair value ratio of just 61.5x. For anyone utilizing a Peter Lynch framework, this signals some significant valuation risk. You are absolutely paying top dollar for future perfection. Which brings us to section 4, the VMware cash flow. This really explains that post-earnings dip we just talked about. So if AI is booming so much, where exactly is the leak? Well, it's right here in the infrastructure software segment. While AI chips make up nearly half of every dollar earned, software, which makes up 32% of their revenue, came in slightly light at $7.18 billion. Basically, it missed Wall Street's whisper numbers. And listen, when a stock is priced for absolute perfection, literally a tiny miss in a secondary segment is all it takes to trigger an after-hour slip. However, before we panic, check out this steady dividend growth. From 48 cents back in 2017, all the way up to a projected $2.42 in 2025. Broadcom isn't just some speculative AI hype stock. It's a high-margin cash flow generator anchored by recurring software revenue, thanks to acquisitions like VMware. This is the exact kind of financial resilience that Warren Buffett looks for in a balance sheet. Okay, Section 5, NVIDIA and Marvell's threat, the stealthy ecosystem war. When NVIDIA's CEO publicly backs Marvell's CEO on stage at Computex with this exact quote, yeah, that wasn't just a polite industry compliment. That was a straight-up declaration of war. NVIDIA is making very deliberate moves to directly challenge Broadcom's grip on the custom chip market. This right here is NVIDIA's Trojan horse strategy laid out perfectly. By supporting Marvell, NVIDIA provides hyperscalers with an alternative to Broadcom. But here is the genius part. They integrate Marvell's chips into NVIDIA's own NVLink Fusion architecture. So even as tech giants try to build non-NVIDIA custom chips to save money, NVIDIA still manages to retain control of the network and basically collects a toll or a tax on the whole deployment. And you know what? The war is expanding to the literal physical limits of the data center. Marvell is rapidly gaining traction as a secondary supplier for giants like Google and Amazon, especially when it comes to the next big bottleneck, optical interconnects. Marvell's massive $5.5 billion buyout of Celestial AI is a huge bet on replacing traditional copper wiring with photonic light fabrics. If Marvell wins this optical battlefield, Broadcom's supposedly unshakable moat could definitely start to crack. Which brings us to our final section, Section 6. Is the premium justified? Let's weigh the bull versus the bear. $100 billion. This represents Broadcom's reiterated target for AI semiconductor revenue by fiscal year 2027. It is an absolute anchor for the bull case. Management isn't backing down from this number. And honestly, if they can compound revenue to hit this $100 billion milestone, that massive premium we saw earlier might actually be entirely justified by the sheer scale of those future cash flows. So I want to leave you with this final provocative thought to weigh against your own portfolio risk. Does a $100 billion AI pipeline actually justify paying 84 times earnings today? Or will Marvell and NVIDIA's stealthy ecosystem war eventually crack Broadcom's moat? The AI infrastructure war has honestly only just begun. So use the framework we built today, watch those valuation metrics really closely, and make your play.